Alphabet earned $112 billion in 3 months. That's the biggest quarterly profit in the company's history. And in the exact same 3 months, it burned cash, negative $5.9 billion. Both of those are true. And the reason they're both true is also the reason Google looks cheaper right now than it's been in years. And isn't. Here's the number. Everything else hangs on. Google reported $9.11 of profit per share for the quarter. $6.26 of that was a gain on shares of other companies that Alphabet owns and has not sold. Alphabet says that itself in its own filing. Take it out, and the quarter was about $285. So when a stock screener tells you Google trades at 17 times earnings, that number is built on profit that didn't come from the business and mostly didn't come in cash, which raises the only question that matters today. If 17 is wrong, what is the real number? Before I take anything apart, let me be fair to it. On my health check, this business scores 91 out of 100. Grade A. Return on invested capital is 28%. That's the one I care about most, and here's what it means in plain English. For every dollar Alphabet puts into the business, it earns 28 cents a year back. Most companies would take 10. And it isn't a fluke. It's been in that neighborhood for a decade. Revenue grew 15%. Earnings per share grew 34%. And the part I'd point at hardest, Google Cloud did $24.8 billion in the quarter, up 82%. Its operating profit went from $2.8 billion to $8.8 billion. That is not a science project anymore. That's a large, fast, profitable business inside a larger one. So this is a wonderful company. Nobody sensible argues otherwise. The argument is about the price, and those are two completely different skills. Now the problem. Alphabet reported $112 billion of profit. The cash the business actually generated was $39 billion. And then they spent $44.9 billion in that quarter on data centers and equipment. Spend more than you brought in, and you've got nothing left over. That's the negative $5.9 billion from the top of the video. The money left over after paying for everything, gone, and then some. And they went and raised money to keep going. $49.6 billion through stock-linked financing, plus $20.3 billion of borrowing. Here's the honest way to hold that. A company spending like this either believes something enormous is coming, or it's defending something it can't afford to lose. Probably both. But you don't get to call it cheap and ignore that the cash is going out the door. Now let me make the other side's case properly, because it's strong. In the same filing, Alphabet says it has $519.5 billion of work customers have already committed to, and it hasn't delivered yet. 513.9 of that is cloud. Alphabet expects a bit over half of it to be delivered within 2 years. That's not cash in the bank, and it is not guaranteed profit, but it is contracted future business, and it's the best answer to my cash complaint. The scale is the part that matters. $513.9 billion is more than 20 quarters of today's cloud revenue already waiting in the book. And cloud is not just growing. Its operating profit already went from $2.8 billion to $8.8 billion. So if those customers stick and cash flow follows, the spending is not panic. It's capacity for a business that is already filling. In that version, the spending isn't a problem. It's the whole plan. So the real question isn't whether Google is a good business. It's whether that spending turns back into cash before the price stops making sense. Back to the price. On reported numbers, Google earns about $20 a share this year. And at $3.44, that's your 17 times. But we just took $6.26 out of 1 quarter. And year to date, the same kind of paper gain runs to $135.8 billion. Strip the paper out of the whole year, and you're closer to $13 a share. At $3.44, that's about 26 times earnings, and Google's own long-run average is 24.4. So here's the sentence. Google isn't trading at a discount to its history. It's trading slightly above it. The discount was never there. It was $99 billion of paper, which, by the way, isn't nothing. The filing shows about $94 billion of SpaceX shares Alphabet isn't allowed to sell yet. Those stakes are real. They're just not spendable, and they're not the search business. If you're getting something out of this, tells the algorithm to put it in front of other people who actually want the numbers. That's the whole mechanism. So what's it worth? I run 3 futures and weight them. A quarter, a half, a quarter. Those weights are my judgment, not a probability of profit. Each one comes down to the same 2 things. how much it earns 10 years out, and what buyers will pay for $1 of those earnings when it gets there. If growth slows and buyers only pay what they'd pay for any grown-up business, the downside case is $101.28. The base case, earnings roughly where the analysts have them and buyers paying about what they've historically paid for Google, is $282.53. The upside, where cloud keeps compounding and buyers pay a premium for it, is $419.11. Weight those together, and I get $271.36. That's the odds-weighted read, not a target and not a prediction. The stock closed at 344. So today's price sits above my weighted number. Run it forward, and you're being offered somewhere around 9.5% a year. And I want to be careful here because 9.5% is a perfectly good return. This isn't a disaster. It's just not extra. An extra is the entire reason to own one company instead of a basket of them. Put it another way, the 8% lane tells you what the math says if market-like returns are enough for you. Google's worth about $390. It looks cheap, but for one company, I need more than market-like. My hurdle is 12% because a basket does not have Google-specific risk. At that bar, I want it nearer 271. If you need 15, you want 208, and you're going to be waiting a long time. The chart's the best argument against buying today, so it gets a fair hearing. Price is below the 50-day average at 353 and above the 200-day at 332. Moving averages just tell you the direction the tide's running. Right now, those two disagree, which means the trend is unresolved, not down. RSI is at 46. That's a momentum gauge. Over 70 usually means it's run hot. Under 30 means it's been beaten up. 46 is the boring middle. MACD is below its signal line, which is a fancy way of saying the recent trend is weaker than the one before it. Money flow is neutral at 53, but Chaikin money flow is slightly negative, modestly more selling pressure than buying on recent volume. And point and figure, which I use for one thing, where the buyers and sellers have actually shown up, has resistance at 372 and support at 296. It's pulling back inside an uptrend. Put the panels together, a stock in a long-term uptrend, going through a short-term wobble with no confirmed setup. Defensive. Nothing here says go, and nothing here says run. So, business. Exceptional. And I'm not going to pretend otherwise. 91 out of 100, 28% returns on capital. A cloud business growing 82% with $500 billion in contracted future work behind it. Price. Not cheap. 26 times clean earnings against a 24.4 average and a weighted value of 271 against a 344 stock. Chart. Defensive, unresolved, which for me makes this a watch list name, not a buy today. Not because anything is broken, because I'm not being paid extra for the risk of owning one company instead of a basket, and that's the only reason to take it. Here's my trigger, and it's closer than you'd think. At about 325, this pays me 10% a year. That's 5% below where it's trading. At 271, it clears my 12. And here's what would change my mind without the price moving at all. If free cash flow turns back positive while cloud keeps growing, then the spending was the plan working. And I'm wrong about the price. Next report is October 28th. That's the number I'll be looking at first. Not revenue, not earnings per share. Cash. The other thing I'd watch. If Alphabet ever sells a chunk of those SpaceX shares, the paper turns real, and this whole conversation changes. That's how I'm reading it. This is my analysis, not advice, and your bar isn't my bar. If you want the numbers rerun when the story changes, subscribe. That's exactly what I'll do after October.